Hey everyone, I'm Professor Stefan, and in this video we are going to start non-current liabilities. So non-current liabilities, like you might expect, are just our liabilities that we are going to pay off in more than 1 year out. And these liabilities usually fall into kind of one of two groups. They could be notes payable or bonds payable. And the nice thing about both notes payable and bonds payable is that accounting-wise, they're treated nearly identically. Both are going to be valued at the present value of the future cash flows that you're going to pay out. So that is going to be the liability on your books. Both of notes and bonds are going to have a maturity date where you kind of pay off the remaining balance of that note or bond. Both are going to have a stated interest rate or a coupon rate if you're making, periodic coupon payments with those liabilities. And both could have a premium or discount that kind of gets amortized over time. So accounting-wise, kind of the baseline treatment of these are going to be identical. It's more in kind of the economic details of how these work that they differ a little bit. Where notes payable, these are kind of contracts with one or maybe a few parties that are going to lend you money. So this is usually with other banks, maybe with some other company at some point, but usually with one bank or a series of banks that decide to get together and loan you some money. So this is issued to a small group of creditors. These are not traded publicly. And these could be used by large or small companies because you only have to negotiate with, a handful of parties. But within these things, there are kind of covenants and oversights because the banks want to be protected. And because there's not a whole lot of people monitoring, right, they can go in and they can say, hey, you have to have a certain, debt coverage ratio, a certain EBITDA, et cetera, et cetera. And so they're going to monitor to make sure that you are performing okay in terms of, as a business, so that you're going to be able to pay back this loan. Bonds, on the other hand, these are publicly issued debt. So where you are basically borrowing money from a huge number of people that have chosen to kind of loan you this money. So this usually only kind of works for very, or larger companies that kind of have access to this public debt. It's more expensive to issue, but you can kind of potentially get, pretty large sums here. And an individual bond is going to be issued in a denomination of $1,000. And so kind of each bond is $1,000 that you borrowed, and you issue a whole bunch of those in order to, borrow the however many millions you end up needing. And then these bonds can be traded on the open market between the people that, loaned you money or want to kind of have a receivable from you in the future. So in this video, we're going to start with notes, and notes are a formal financing agreement. So we have a written agreement here that is going to charge interest on the borrower. So this is a written promissory note that specifies the amount and timings of future cash flows. It can be issued to kind of borrow cash if that's what you need, or it could be issued for specific transactions. If you purchase a building or a piece of PP&E that's especially expensive, you could write up a promissory note for this. In terms of what you guys might get into in a few years, think of mortgages, right? You're kind of taking a promissory note and borrowing money today to fund a specific purchase of a house. And our basic accounting is going to be to record the note payable at the present value of the future cash flows that you're going to make. So we're going to discount all the future cash flows back using the market rate of interest. So if you remember from our note receivable classes, what we learned is that whatever the coupon rate or the stated rate is on a given note, you are always going to borrow at the market rate. And so the thing that is going to adjust is the amount that you borrow. So a quick review of discounts and premiums. These work just the same way as they did for notes receivable. So a note issued at face value has the coupon rate, which determines your periodic payments that you're going to make, kind of the periodic interest payments every 6 months or every year. If that coupon rate is equal to the market rate, you will issue at face value. So the amount you borrow is going to equal the face value that you're going to pay back, and your interest expense is going to equal the coupon payment every period. Now, if you issue your note at a discount where the coupon rate is less than the market rate, well then the people lending you the money are going to lend you less than the face value because they're going to get back smaller coupon payments than they could get from somewhere else. So you're going to borrow less than the face value, and your coupon payments are going to be less than your interest expense every single period. And so as you record interest expense and make coupon payments, kind of the difference between those is going to amortize that discount. And effectively what that is going to do is it's going to raise your liability incrementally over time for all of the interest that you owe, but you have not yet paid. And so that interest you owe but haven't yet paid is going to get paid back in the principal face value when you make that final payment at the end. And if your stated rate is greater than the market rate, you are going to issue at a premium, so you're going to borrow more than the face value. And so the amount you borrow goes up. And when you make a coupon payment, your coupon payment is going to be larger than your interest expense. So effectively what you're doing is with this larger coupon payment, a piece of that is for the interest you actually owe, and a piece of that is actually repaying that extra principal that you borrowed. So you're going to pay down your principal a little bit at a time with each coupon payment. And I want to emphasize here, because students always get mixed up on this, your coupon payment is always the coupon rate times the face value of the note, whereas your interest expense is always the book value or the carrying value of the note times the market rate. And so we have completely different equations for the amount of cash you kind of pay every 6 months or every year, and the amount of interest expense you record. Now, the nice thing is those formulas hold, whether you're at face value, at a discount, or at a premium. The formulas stay the same, where the coupon payment is coupon rate times face value, and the interest expense is carrying value times market rate. So those are key formulas for this topic that you want to write down and keep on a cheat sheet for the exam. So what I'm going to do here is I'm going to walk through 3 examples, one at face value, one at a discount, and one at a premium, just to kind of illustrate how the borrowing and the interest and coupon payments work in each of these scenarios. So let's say we have on January 1st, 2020, Felipe Inc., issued a 3-year $50,000 note issued to Maurice Banking with a stated interest rate of 8%, and it's to be paid annually on December 31st each year. The prevailing market rate is 8%. So we have an 8% coupon rate and an 8% market rate. Now, when these are equal, we said we're going to issue this at a face value. So we are going to borrow the $50,000, that is the face value of the note, and we're going to record a note payable liability for that $50,000 because the liability will always equal what we owe in present value terms. Now, when we make our coupon payment here, remember our coupon payment is going to be the coupon rate of 8% times the face value of $50,000. And so we're going to make a coupon payment of $4,000. And our interest expense is going to be the market rate of 8% times the carrying value of the note, which if you remember from the last slide was $50,000. And so our interest expense will also be $4,000. Now at the end of the note, when we repay this principal on December 31st, 2022, 3 years later, we are going to pay back the face value of the note, so we'll credit cash for $50,000 and debit our note payable because we have now extinguished this liability. Now, let's tweak one thing here, and this is usually the piece that's going to change. What if we change the coupon rate of the note? So instead of making 8% payments every year, what if instead Felipe Inc. makes 0% coupon payments every year? So they're going to make no payments over the course of this note until they repay the full $50,000. Now, if you are the lender in this scenario, you would look at this and say, hey, I can go get 8% somewhere else because that's the market rate. And so if Felipe Inc. is not going to pay me 8% every year, well, then I'm going to loan them less than the $50,000 so that when they repay me $50,000, that difference between what I loaned them and what they repaid me is going to be all that interest at basically an 8% annual rate. And so what we need to do here is we need to present value the future cash flows. And if we look at the future cash flows, kind of what am I going to repay? Well, I'm going to make no coupon payment in year 1, no coupon payment in year 2, and no coupon payment in year 3. Instead, my only cash flow is going to be the repayment of $50,000 at the end of the note in 3 years. So I am going to present value that $50,000 payment, so that's my kind of future value or my face value, with an N of 3 and a market rate of 8%. And again, I said my payments are 0. So the present value here is $39,692. And so that means as the borrower, I can borrow that $39,692. And because I borrowed $39,692, my liability will equal $39,692. But of course, the way GAAP likes to do this is they like to put the face value of the liability in the note payable account, so the full 50 grand in the credit to note payable, and they like to adjust the note payable with the premium or discount account. And so in this case, if I need to bring my liability down to $39,000, I need to debit my liability for $10,308, and that number only comes from kind of the need to get my liability down to the $39,692. So you kind of end up plugging that number. And so I'm going to debit my discount for $10,308. So my net liability is $39,692. And I want to emphasize again, just like in notes receivable, anytime you see discount or premium, all those mean are, note payable or bond payable. It is just the liability account itself. So you want to think of that as kind of the same nature as the note payable account. So a debit to that is just lowering my liability. A credit to a premium is just increasing my liability here. So there's no difference between note payable and discount on note payable, except different names. That's the only thing. They mean accounting-wise the exact same thing. So when we get to our first, end of the year, we said we make no coupon payment, right? But at this point, we have borrowed money for 12 months. So technically, we have gotten the benefit of that borrowing, and we should incur the interest expense that we're going to have to pay. And if I go back to this slide, remember that $10,308, that is effectively going to be all of the interest that I paid to Maurice Banking. Because if I borrow $39,692 and I repay $50,000, the difference in there is just interest. That kind of Maurice is charging me, right? But all of the interest just gets repaid at the end. And so if I've borrowed money from a year, I've incurred interest expense for a year, and my interest expense, remember my formula is the carrying value of $39,692 times my market rate of 8%. So I have an interest expense of $3,175. And we're going to record the cash payment, which in this case is 0. And the difference between those amortizes my discount or premium. So if I'm saying, hey, I owe $3,175 in interest expense, but I have not paid that in cash yet, well then I have to record a liability for that $3,175 that I owe. Now instead of crediting interest payable, I'm going to credit this discount on note payable. And that's what I mean by amortizing this discount. So my discount is getting credited, and remember discount really just means note payable. So my liability is going up. So instead of crediting interest payable, I credit the discount, but it does the same thing by making my liability go up for that $3,175 that I owe. And then when I get to the end of the note term, I do that 2 more times each year. The interest expense and the amortization amount changes a little bit each year. When I get to the end of the note, I'm going to repay the full $50,000. And so that is going to include the principal of $39,692 that I borrowed, and it's going to include the $10,308 in interest that I kind of incurred but had not paid to Maurice yet. So kind of this $50,000 face value has both principal and interest included in it. And finally, our last example is going to be issuing the note at a premium. So in this case, let's say that the stated rate on the note is 10%. So I'm going to make nice big coupon payments above the market rate. So if I'm going to pay above market rate coupon payments, well then I'm going to demand to borrow a bit more because I only want to, I don't want to borrow at 10% if I could borrow at 8% somewhere else. So we're going to take the present value of the future cash flows, which is going to include a $50,000 payment 3 years from now, and then it's going to include 3 $5,000 payments along the way each year. And so that payment amount, remember, comes from the face value of $50,000 times the coupon rate of 10%. So 3 $5,000 payments, 1 $50,000 payment. If we present value that with an N of 3 years and a market rate of 8%, remember the market rate goes into the present value calculation, we get a present value of $52,577. And so that means I can borrow a full $52,577. Again, we stick the face value into the note payable account, but if I borrowed $52,577, I need a liability for $52,577. And so we plug that difference to kind of increase my liability up to the $52,577. I'm going to credit the premium account for that extra $2,577. And like I said before, premium, all it means is note payable. So it's just making my liability bigger here. Now, as I make coupon payments, I'm going to make a coupon payment at $5,000, right? That's the cash that comes out of my bank account. But my interest expense is the carrying value of the note times the market rate of 8%. So I really only owe $4,206 in interest. Now that extra money that I paid, that extra $794 that I paid in cash above my interest expense is going to go to a debit to the premium. And so think about it. Remember, if premium just means note liability or note payable, a debit to note payable means my liability goes down. And so this extra $794 that I'm paying is essentially repaying the principal on my note. It's repaying that extra amount I borrowed because I'm making large coupon payments above the market rate. And so we do that a couple more times at the end of each year, and my premium falls, my note payable falls along with that as I continue to repay that principal. And I end up at the end of the third year after making that third coupon payment with a liability of $50,000. And so I repay that $50,000 and my note payable goes away as well. Now in both this discount and the premium scenario, you can work this out in Excel if you want to, and honestly I might recommend it just as a little bit of practice so you can see exactly how these work. But the discount and the premium go towards zero. So after your last coupon payment or after your last year or 6-month period or whatever it is, the discount and the premium end up at zero. So that when we repay the face value, that's the only remaining amount we have. We don't have to do anything else with this discount or premium. So last very quick topic when you're kind of promising to pay in the future. So you're issuing a note payable in exchange for some non-cash. So you're not borrowing money, but maybe you're getting a piece of PP&E, you're getting a piece of land, you're getting a building, something like that. We're going to treat the accounting for this exactly like we did under notes receivable, where if we can, at issuance, we are going to measure the carrying value of the note at the fair value of that item we're receiving if we know the fair value. So if we have the fair value, we'll use that for our liability. If we don't have the fair value, then we'll use the market rate and do our standard present value calculation. So it's just kind of one thing is going to take precedence here if that number is available. And then the asset is going to be recorded at the carrying value of the note payable. So it'll be recorded at the fair value if you have it, and if you don't have it, then the new asset will be recorded at the present value of the future cash flow calculation that you do. So closing thoughts, both notes payable and bonds payable, which we're going to get into in class, are measured at the present value of future cash flows. And so accounting wise, these are similar. The actual nature